This isn't just another piece of boardroom drama that only accountants worry about. A serious Volkswagen profit squeeze appears to be unfolding, and it could end up reaching straight into your wallet. Over the first 9 months of 2025, the company's global profit fell by about 61%, finishing with an operating loss in the third quarter alone of roughly $1.4 billion. But the part that arguably matters most for American buyers is what's happening here at home. In the U.S., profit margins seem to have dropped by an eye-catching 67%, and that's likely why the era of easy Audi lease deals and heavily discounted VW crossovers may be quietly fading away. Volkswagen's own 2025 interim report paints a brutal picture. While sales numbers stayed relatively flat, the money VW makes on each car has evaporated, especially in the United States. While Europe saw a small dip and Asia-Pacific was almost flat, the U.S. market fell off a cliff. This financial bleeding is the result of a perfect storm, but one factor stands out as the main culprit. The biggest hit came from a 25% tariff on imported cars and parts, stacked on top of the old 2.5% duty. This pushed the total tax on many European cars to a crushing 27.5%. Volkswagen officially told investors this tariff wall will knock up to $5 billion off its 2025 results. This pain was then compounded by another multi-billion euro punch from Porsche's costly EV strategy reversal. Perhaps the most puzzling part of Volkswagen's 2025 story lies in a paradox that feels both familiar and hard to accept. The company is still selling cars, production lines are still running, dealerships are still opening their doors every day. Yet profits seem to have quietly evaporated. In the auto industry, many people with business experience likely understand a truth that sounds contradictory at first. Selling more cars does not necessarily mean making more money. The year 2025 appears to be a fairly clear example of this disconnect. Volkswagen is still delivering vehicles, but each car now seems to generate far less financial value than it once did. Looking at the global picture, Volkswagen's profit performance over the first 9 months of the year does not look particularly encouraging. Profits declined sharply, not just in a single quarter, but across multiple reporting periods. This gives the impression that the situation is not simply a short-term stumble caused by timing, but rather something closer to a system-wide pressure weighing on the entire business model. In the United States, Volkswagen's profit margin fell more deeply than in any other region. A market that was once seen as a place to offset difficulties elsewhere now appears to have become the area where profits are being eroded the fastest. This quietly raises a difficult question. What has made the U.S. market, familiar, large in scale, and once critically important, so much harder to make money in? The answer likely does not lie in how many cars are sold, but in the numbers that rarely show up in advertisements. Profit per vehicle. When a Volkswagen is sold in the U.S., the amount left after production costs, import costs, compliance expenses, and other charges seems far thinner than before. Cars are still delivered, but the leftover margin, the part that sustains the entire system, has shrunk. Comparing regions helps clarify this picture without relying on strong language. In Europe, profit margins have declined, but the scale still appears manageable. In the Asia-Pacific region, some markets remain relatively stable. In the U.S., however, several unfavorable factors seem to stack up at the same time, creating a gap that is noticeable just by looking at the numbers. This decline becomes more striking when recalling that Volkswagen was once known for relatively tight cost control. Stable profit margins over many years were not just a financial result, but the foundation for how the company priced its vehicles, managed distribution, and built its product portfolio. When that foundation begins to erode, the entire structure above it starts to shake. Profit margins, after all, are not just figures for investors. They function more like oxygen for the entire ecosystem, supporting incentives, discounts, and the ability to invest in future vehicle generations. When that oxygen level drops, a company's room to maneuver appears to shrink along with it. If one looks at the numbers long enough, a pattern begins to emerge. Volkswagen's profit decline in the U.S. does not seem to stem from a single bad decision. There is no obvious moment to point to. Instead, it looks more like the result of multiple layers of cost quietly stacking up, steadily, until already thin margins could no longer absorb the pressure. In the car business, when profit per vehicle is already compressed, just a few unfavorable factors appearing at the same time can trigger a steep slide. In Volkswagen's case in the U.S. market, costs appear to sit at the center of the story. One of those cost layers is import tariffs, often described as an invisible wall, but one that is very real on accounting statements. Vehicles and components imported into the U.S. pass through several layers of taxes and fees. These costs do not disappear, and they cannot be fully passed on through higher prices without provoking market resistance. Importantly, tariffs rarely cause sales to slow immediately. Dealerships still see customers. Cars still roll onto the road. But over time, tariffs seem to quietly eat away at profit per vehicle. Bit by bit, steadily, and often unnoticed if one looks only at sales volume. For European vehicles, this impact appears more pronounced. The higher the vehicle price, the larger the value-based tax burden. At the same time, profit margins that were never especially thick become even tighter. For Volkswagen, the situation grows more sensitive because many higher-spec trims and high-value components are still imported. As a result, each vehicle sold in the U.S. seems to carry a heavier cost load than before, even if buyers do not clearly feel the change. The challenge is that Volkswagen is not a purely low-cost brand that can compensate with volume, nor is it a luxury brand with margins thick enough to absorb cost shocks. It seems VW sits right in the zone where rising tariffs and costs exert the greatest pressure, an uncomfortable position in any cycle. A comparison with BMW and Mercedes highlights this contrast without the need for harsh words. Those brands built large manufacturing plants in the U.S. relatively early, not just for assembly, but also to develop local supply chains. This gives them clear advantages: significantly lower tariff and logistics costs, and greater flexibility in adjusting prices to market conditions. Volkswagen, along with related brands like Audi and Porsche, appears to remain more dependent on imports. Lower levels of localization mean a very different cost base, even though all carry the German car label. The result shows up clearly in margins. BMW and Mercedes seem to maintain relative stability, while Volkswagen's margins are eroded more sharply, even when sales do not fall by the same degree. And the story does not end there. Inside the Volkswagen Group itself, internal pressures are also present. Large investments spread across multiple brands and regions require steady cash flow to sustain. At the same time, the electric vehicle strategy, now in a period of adjustment, does not yet appear to deliver proportional short-term profits, while research, production, and restructuring costs remain high. As a result, profits from traditional vehicle lines seem to be carrying part of this burden. When all of these factors converge in the U.S. market, high tariffs, heavy import costs, and global investment pressure, it becomes easier to understand why the U.S. emerges as the most pressured point in the system. What matters most is that this does not appear to be the story of one individual or one specific decision. There is no simple target for blame. This is a story about cost structure and operating models. And when that structure no longer fits a new environment, even a strong brand can struggle to protect its profits. In the boardrooms of large corporations, profit figures may look like nothing more than colored columns on a presentation slide. But over time, those numbers tend to find a way out of the meeting room, across spreadsheets, and eventually land directly on the buyer's invoice. Volkswagen's profit decline in the U.S. does not appear to stop at financial reports or investor briefings. It seems to gradually filter downward, reaching the level where end consumers feel it most. What stands out is that this shift does not necessarily stem from a sudden change in buyer behavior, but rather from companies being forced to adjust how they survive in an increasingly constrained environment. When profit margins become thin, a company's options narrow quickly. An automaker cannot absorb losses indefinitely just to preserve a friendly image. Profit is not merely a figure to satisfy shareholders, it is the resource that sustains warranties, service networks, parts availability, and future investment. For Volkswagen in the U.S. market, once margins appear to have been significantly eroded, the capacity to absorb additional costs is almost gone. In that context, only a few familiar financial levers remain: adjusting prices, scaling back incentives, and reshaping the product lineup. These moves feel less like marketing tactics and more like tools for survival. Price increases in practice do not always appear as a higher sticker number on the windshield. They can arrive more quietly. Higher default trims, fewer entry-level options, or features that were once optional becoming standard. For many buyers over 55, the feeling is often not "prices went up," but rather, "why does this car cost more when it doesn't seem very different?" Those most affected may be cash buyers or people who tend to keep their cars for a long time. For them, a vehicle is not a short-term trend, but a multi-year asset. As input costs rise, the sense of making a reasonable purchase becomes harder to pin down. At the same time, incentive programs tend to shrink. For years, lease deals, cash rebates, and financing support helped Volkswagen maintain appeal among middle-aged and older buyers. These programs reduced upfront pressure and made purchase decisions feel easier. As incentives fade or become less attractive, the buying experience changes with them. Fewer standout lease offers, tighter financing terms, and widening price gaps versus certain competitors. Psychologically, buyers may feel less urgency, less of a sense that this is the right moment. Another quieter consequence is the removal of low-margin trims. Often, the versions seen as the most reasonable also carry the thinnest margins. Import costs do not distinguish between base and higher trims, and when cuts are needed, these variants tend to disappear first. For loyal customers, this can feel unfamiliar. Familiar configurations become harder to find. Choices are pushed upward, or, in some cases, buyers are nudged toward another brand altogether. Importantly, these changes do not appear designed to create artificial scarcity or pressure consumers. They look more like necessary adjustments to operate within a new cost structure. When that structure changes, the buying experience changes with it, whether buyers are ready or not. At first glance, Volkswagen and Porsche seem to belong to entirely different worlds. One is associated with mass-market vehicles, high volumes, and everyday transportation for millions of families. The other stands as a symbol of performance, high prices, and a loyal customer base willing to pay not just for a car, but for the feeling and reputation attached to it. For decades, these two names were rarely mentioned together in stories of financial strain. To be clear, Porsche still appears to be in a stronger position than most of its competitors. That said, a few numbers from the latest financial outlook are difficult to ignore. Based on current exchange estimates, Porsche's operating profit appears to have fallen by roughly 99%, with about $43 million in operating profit reported for the first through third quarters of 2025. This contrasts sharply with roughly $440 million generated through the third quarter of 2024. In both Volkswagen's and Porsche's cases, sales do not seem to vanish overnight. Cars are still on the road, dealerships remain open, and loyal customers, many of whom have stayed with these brands for decades, are still there. Yet when looking closely at profit per vehicle, the picture becomes far less reassuring. Selling cars no longer necessarily means retaining the same level of financial value as before. That realization carries weight, especially for those who once believed a strong brand could serve as a shield against volatility. That shield now appears thinner, or at least less capable of absorbing mounting cost pressures. What brings these two stories together most clearly is cost structure. Despite operating in very different segments, Volkswagen and Porsche face similar types of pressure. Production costs trend upward, regulatory and tariff requirements grow more complex, and investments in new technology must be made early, while returns arrive more slowly than hoped. Notably, these expenses do not resemble temporary burdens. They look structural, difficult to cut quickly, and even harder to reverse, even if markets stabilize. Against this backdrop, both companies' responses appear different from a few years ago. Rather than aggressive expansion, maximum volume, and blanket coverage of every segment, current strategies seem far more cautious. Incentives are more tightly controlled, output is more carefully managed, and product portfolios are no longer expanded at any cost. At Porsche, electrification goals appear to be reassessed with a more pragmatic lens. At Volkswagen, the focus seems to be shifting away from "how many cars can we sell" toward a more fundamental question: what does each car actually contribute? Interestingly, neither company seems eager to blame the market or consumers. nor are they rushing back into a growth-at-all-costs race that once felt familiar. Instead, they appear to accept certain trade-offs: fewer choices for buyers, higher prices than past expectations, and possibly slower innovation cycles. This approach may be viewed as conservative, but in the current environment, it also looks like a natural response aimed at preserving what remains. Looking back at how Volkswagen entered American life, many people may realize that the brand never truly tried to become a luxury symbol. At the same time, it did not present itself as a purely low-cost option where everything is stripped down to achieve the lowest possible price. Instead, Volkswagen seemed to choose a different path, bringing a European spirit, adjusted just enough to fit the realities of middle-class American families. In a market long accustomed to large, powerful, fuel-hungry vehicles with an imposing presence, Volkswagen came to represent a different way of thinking about cars. Less showy, less about status, and perhaps more deliberate. For many Americans, especially those who have been driving for decades, this difference was not necessarily a weakness. On the contrary, it created the sense of a considered choice rather than an impulsive decision. Volkswagen's European roots carried a distinctive feeling. It was a sense of engineering taken seriously, of design that did not chase short-lived trends but seemed guided by clear purpose. Yet, in the U.S., Volkswagen's pricing generally remained within reach of the middle class. Buyers did not need to change their lifestyle or sacrifice other priorities just to own a car with European character. As a result, Volkswagen became a natural step up from mainstream cars without quite crossing into the world of luxury, a balanced position that few brands manage to hold for long. For those who have lived through multiple phases of the American auto market, this appeal is even easier to understand. Many of them once drove domestic cars, then switched to Japanese brands, and gradually came to value long-term costs, stability, and durability over the fleeting excitement of signing a purchase contract. In that context, Volkswagen offered a solid, planted driving feel and a sense of confidence at highway speeds or on long trips. It did not focus on impressing with flashy details or attention-grabbing design. This suited buyers who had moved past the stage of buying a car to make a statement, and now viewed a vehicle simply as a dependable tool. In the case of Volkswagen, the idea of German engineering in the U.S. seemed to be more than a marketing slogan. It felt like an implicit promise built through real-world use. That promise showed up in steering feedback, in the solidity of the chassis, and in the stability of a car that performs day after day. Volkswagen buyers likely did not expect glamour or short-term excitement. What they looked for was consistency, the sense that the car would behave the same way this year, next year, and 5 years down the road. These values helped create a distinctive level of customer loyalty for Volkswagen. In the U.S., fuel efficiency was once a major advantage, especially for families who drove frequently when fuel prices were unpredictable. Durability and longevity were also key. Cars were bought to be kept, not replaced after just a few years. Most importantly, many buyers felt the money they spent was worth it. Not so cheap that it raised concerns, but not so expensive that it prompted doubts about overreaching. A 67% drop in profit may be better understood not as an immediate shock, but as a signal that Volkswagen is quietly adjusting its priorities in a new environment. The focus appears to be shifting from volume toward preserving profitability, and this subtle change is beginning to affect buyers directly. Rather than reacting with alarm, it may be more useful to understand the context and make more informed decisions. In today's market, what do you think truly defines the value of a car? Share your perspective in the comments below. To wrap up, this video is created strictly for educational and informational purposes. All the content is based on publicly available sources, manufacturer documentation, and general automotive research. It is not intended to promote, endorse, or criticize any specific car brand, model, or dealership. Our goal is simply to provide practical insights that can help you better understand how the automotive market works and make smarter decisions when it comes to buying, maintaining, or using vehicles. Thank you for watching. If you found this video helpful, don't forget to like, subscribe, and leave a comment sharing your own experiences or thoughts about car ownership. We'll see you in the next video for more insights and discussions.